Okay, position sizing strategies to meet your objectives. So this is going to go with, we're going to put this in with, for example, the monthly rebalancing, the core workshop that's already online, because people need to know this sort of stuff. And there was no really position sizing strategy given with that. So if you were to do the core trading strategy, which is monthly rebalancing, what would you might do for position sizing? So you'd have to ask some questions. What am I trying to accomplish? In other words, objectives. Are you trying to outperform the S&P 500? Might be the objective. Are you just satisfied with that? What I mean, if the S&P is down 30%, are you satisfied with being down 25%? Or if it's just down for the year, are you happy being down less? Can you tolerate a 10% monthly drawdown? How about a 25% yearly drawdown? So these are all questions you need to potentially ask yourself if you're going to do something like the monthly rebalancing system. Yes, it outperforms the S&P 500, but you still need to look at these kinds of questions. So suggestions on what to do for the system. Number one, simple. Allocate 100% of your funds to the system. Trust the system. Be happy outperforming the S&P 500 and hope it continues to do so in the future. It's one way of going about it. You could do a money market or markets money. So you could allocate a percentage of your portfolio to this strategy and increase the percentage as the profit goes up. So you're going to say, well, I'll trade 25% of my portfolio doing this. But if it keeps doing really well, I'm willing to allocate more. Or if it does well, I'll be allocating more automatically simply because it'll have more money in that section. So you might just allocate 25% to that system and trade other systems or keep the rest in cash. And are you going to pay attention to market type? So typically you're always long. You might be long some things that might be strong in a bear market or not. But are you always going to pay attention to market type? So the monthly balancing system, just as a refresher for those of you who might not know, you have 0 to 3 positions are entered every month based on a blended relative performance over a 3 and 6 month period. So you can watch the core workshop if you haven't done that, but that's the basic thing. The price must be higher than the 4 months moving average, and positions must meet this requirement to be entered. So the exit is, most positions are just held for a month. You have a 10% trailing stop, or so if it goes down at least 10, if it goes down 10%, you get out. Or you might just rotate out of the position because you have another one to get into the next month, which might be at a loss, it might be at a small profit, it might be at a large profit. If it's at a large profit, you'd probably stay in it. Back-tested data used from 2002 to 2013 shows 61% winning trades. The expectancy is 0.18R. The SQN is 3.26. Max win is 1.9R. Max loss is minus 1.5R. So let's look at a couple of different objectives with this system. Trader A objectives: maximize or minimize management, outperform the S&P, maximize the ending equity. Trader B objectives, again, minimize management, so you don't have to do much. You're just paying attention to this once a month. Outperform the S&P. You want to maximize the ending equity, but you also want to minimize your drawdowns. So position A, Trader A's position sizing strategy is to invest 100% every month. Trader B is to invest 100% every month when the market type isn't bear. Now, the one drawback for that is when the market type is bear, but it changes during the month and you get a strong move out of it, and you have high volatility in bear markets, you're going to miss some of the strongest up moves. So if Van's market type is bear, you stay entirely in cash for that month. So what happens? Both traders met their objectives. So monthly adjustments that outperformed the S&P. The ending equity was 894K. What was the start, RJ? 100K. The average annual gain was 22%, and you had a minus 29% drawdown, and you also had a 23-month drawdown. So that's almost 2 years of drawdown. Trader B, so could you take 22 months of drawdown? Trader B outperforms the S&P. The ending equity is 799K, so not as high. The average annual gain is 20%, but they slept well through 2008. The biggest drawdown was 10%, but they still had a 19-month drawdown.
Drawdown of, say, 19 months, that's the time period during which you're negative relative to your peak?
When you're below your peak.
When below your peak, okay.
So it's negative until you hit a new peak. So there's just two examples of different ways that you could, I gave some earlier. It's harder to test this with position sizing since it's more an asset allocation strategy. So your position sizing is how much of my portfolio am I going to allocate to the strategy, because it's basically in there for a month. There's the two equity curves. So you basically must have gotten out of it here and been flat through all this. You missed this drawdown. No, if instead of sitting in cash, Trader B used a bear market system, in bear markets, Trader B would outperform Trader A. Position sizing strategies used to meet specific objectives. The systems with known or multiple distributions for specific market types. So, what are my objectives to trade a particular system? So one, make sure I only trade it in the market types for which it was designed. Aggressive performance, being willing to lose it all, but there's also with what probability? You know, I'm willing to take a 1% chance of losing it all, or, you know, I'm willing, an example of the opposite is Ed Seykota once told me when he started that they'd just throw $5,000 at the system, and it failed 3 times, or 2 or 3 times, and then it took off and it hit, and they turned it into millions. But, you know, $5,000, I'm sure at that time was probably a lot of money to him as a graduate student at MIT. And they did it a couple of times, and they were willing to do that because they looked at what could happen. And so it's different objectives, but that's, so you might understand that I'm going to make a lot of money eventually when it hits, but I could lose stakes of like $5,000 and then I have to raise it again and start again. Now, if you want to start with $500,000 chunks, that might be a different story. Aggressive performance, but specific drawdown limits, that's another possibility. Best performance with specific drawdown limits, or make sure I don't exceed the drawdown numbers. So generally, these are the, you can be much more specific, like we talked about before in the objective section. I want to make 250%, and I don't want to have more than a 25% drawdown, something like that. And I want to maximize the difference between the probability of making my goal and minimizing my probability of the drawdown. So what risk percentage should I do? That's how you get much more specific. So an example of a position sizing strategy, you could do a fixed percentage, such as 1%, and then you have to pay attention to portfolio heat. So each position would have 1%, but how much total portfolio heat? All of the positions together could add up. If you have 20 positions, each with 1% risk, there's an old saying that when the tide goes down, all ships go down at the same time. When the markets go down, almost all ships go down, or all stocks go down with it. And that doesn't matter whether you're in commodities or whatever, they all tend to grow together. So you need to consider portfolio heat as your overall risk. Group risk, how much risk are you going to put in precious metals, or how much risk into high-tech stocks, or how much risk into any one particular area? Because those are going to be more correlated than, say you had 5 different stocks in 5 different areas. Now, other strategies. You can scale out to smooth equity curves. You typically have to have a fairly big account for this to make sense. But an example of it is a scale out strategy says, I'm going to trade 3% volatility. So you're going to have a certain risk, but you want your volatility, open volatility exposure never to be more than 3%. In other words, when you look at the volatility in this position, and you know what the average true range is, and you look at what that is and the exposure you have now, you never want that to be more than 3%. Typically, when prices go up and markets go up, as they get towards the top, they get more and more volatile. An example, Qualcomm in late 1999, when it was approaching 600, people are saying Qualcomm 1,000. Well, Qualcomm at that point could have a regular volatility of almost $100. And that's really high volatility. Oil, when it takes off and there's a war, takes off really high, and then the next thing you know, you could have volatility that's much higher than your initial stake. Tom Basso mentioned an example. One of his first trades was in silver. He put in a certain amount of risk, and the next thing he knew, as silver took off, it was probably during the Hunt Brothers thing, he had more volatility every night than his initial equity in the position. Now, if you have some manageable way, you might, and you just kept it that way, you probably would get the maximum profits, but you're not going to have a smooth equity curve. So the way to scale out is to basically say, I'm going to keep my volatility at 3%. As the volatility goes off, you scale off positions. You don't add them back on if the volatility gets less, but you continually scale off. So if you started out with something at $11 and it had a $1 volatility, and then it goes to $100 and it has a $13 volatility, you're basically going to keep that volatility at 3%. You're going to have a much smaller position. You'd be doing other things. And the net result is you just have a very smooth equity curve. It won't necessarily make you more money, but smooth equity curves are good in some circles. Scaling in to be aggressive. So this is an example of you want to make more money. So, your position starts to make money, and let's say it's based on ATRs, the average true ranges. It goes up. You get in with a certain position. It goes up one ATR, you add another position. It goes up another ATR, you add another position. You pyramid in, so when you get a good move, maybe you scale in 3 times, you have a lot more chance. It's 3 times bigger than your normal position, but you have a lot more chance to make money. That's being very aggressive with your position. That stuff's all in the position sizing book in a very detailed way, but I'm just reviewing this for everyone to understand that you can have, with your system, very, very different position sizing strategies that will make all the difference in the world, and as you saw from the game, makes position sizing is most of your performance variability. Markets money to be aggressive. So markets money means money you've made as a profit. And so you start out with a core equity. Core equity might be, say, $100,000. And then you're going to risk, say, 1% of that. But you're willing to risk 5% of markets money. So let's say now your account's up to $120,000. So you're going to risk 1% of the core equity, and we'll say 5%, well, let's make it 10% because it's a round number. So you're going to risk 10% of that $20,000. So your account has gone up by 2 or 20%, but your position sizing has gone up by 300% because you're risking $2,000 on markets money and only $1,000 on the core equity. So you can do that. There are as many markets money type of systems as you can possibly imagine, because there are you can develop mathematical formulas and all kinds of ways in which market money becomes your money. And that's the basic formula. Markets money could be your money after you're up a certain percentage, after a certain amount of time, after a certain amount of some mathematical formula. And there's millions of mathematical formulas. Yeah.
I was just curious if you had any favorites for markets money to be aggressive. I tried a strategy this morning in the game with a markets money.
Well, I would never do markets money in a game in which you only won 20% of the time.
Well, I started out and I realized I was being aggressive and ruination in terms of risk.
I would never use markets money in a system that didn't have pretty close to a 50%, or either have a lot of trades or a pretty high win rate.
Because it's a small win rate.
20%, yeah, you're suddenly going to, I mean, it worked pretty well at the beginning, and you actually had 2 in a row, but then big streaks doesn't work. So, I mean, my staff's designing a position sizing thing where you have trade 1 as a win, and you take what you won on trade 1 plus what you'd risk on the next trade, and you add it all together on trade 2. And then you go back down to, maybe you go back down to 0 after that. But so you make a lot of money when you get 2 right in a row. And seems to be very interesting. And it depends on your win rate. So if your win rate was like 70%, you might go for 5 in a row, and you make huge profits from that. working to minimize drawdowns. So that could be another strategy. And the strategy here is, you want to make sure you're not giving back money, and you base your position sizing on the kind of logic that it would take not to give back a lot of money. Scale out of positions really rapidly, things like that. So here's a trading system. So RJ set this up. It's going to be a surprise to me what it says, even though I read it once. So we have a trading system that has these results. 6 trades were minus 1.5 R, 21 were minus 1, 32 trades were scratch, 24 trades were plus 1, 14 trades were plus 2, and 3 trades were plus 3. So there's the distribution. The expectancy is 0.31 R. The SQN is 2.7. And it may, with 80 trades per year, the expectunity is 24 R. And you only have one position on at a time, so portfolio heat is not significant here. So your trading objectives, let's say it's a hedge fund return, you'd like 20%, no drawdowns, no more than 8%. Your position sizing strategy might be 1% equity per trade. If you do that, your expected results, 24% return, 7% drawdown. So improved returns. You want to improve the returns over objective 1. You want to minimize any loss to your initial equity. Position sizing, you risk 1% per trade and 2.5% of markets money. So same system, same trades. The expected results are a 34% return, a 7% drawdown to original equity. Is the worst case scenario. So trading objectives, you want a greater than a 70% probability of a 25% return, less than a 20% probability of a 5% or greater drawdown. Position sizing strategy, you risk 1.5% equity per trade. Expected results, 74% chance of a 24% return, 15% probability of a greater than 5% drawdown.
I know it's not on the slide and maybe you don't know the answer, but I'm looking at the, so, I wouldn't be heartbroken in this scenario over maybe a 6% drawdown, but I mean, a greater than 5% could be a lot more. Is there, when you came up with these numbers, I mean, is there some way
I didn't come up with the numbers. RJ came up with them.
Okay, so RJ came up with the numbers. Is there some way, RJ, of knowing, like, what's the probability of a 50% drawdown or?
There are ways to use a simulator to help calculate that.
I thought you were going to ask me, what is the probability? Not.
Well, that's kind of what I wanted to know.
Is there ways to do that? Because I certainly didn't know. So shoot for the moon might be your objectives. You want to maximize return, and you're not worried about drawdowns. So your position sizing strategy is 15% equity per trade. Expected returns, greater than 1,000% return. Greater than a 50% probability of a 5% drawdown, and I guess 65% drawdown is the maximum.
No, it's a 5R drawdown.
Yeah, greater than a 50% probability of a 5R drawdown. And what's the 65%?
That's 5R.
5 times 15%.
Okay. So another objective might be break even with a 3 with big upside potential. So you want hedge fund returns with a good chance for upside, willing to lose a portion, say 20% of your equity. position sizing strategy is 2 accounts. For 80% of your equity, you risk 1.5% per trade. For 20%, you risk 15% per trade. So this is called a 2-box system. Expected results.
Low probability break even, greater than a 20% return is likely with a much higher upside potential.
Okay. And a 50% probability of a 14% loss with a maximum about 20%. So those are examples. You know, all we did was take one distribution and just show you what you can do with position sizing for that particular distribution. So when you take any of the systems that you might be learning in one of our classes, these are the key decisions you need to make for it. What are your objectives? What do you want to do with it? And how are you going to trade it to meet those objectives? And all these different strategies would apply.